Nvidia testing $200, down 18% on the year. On the same week the Dow closed at a record high. That split screen is the whole story of the week, and we're going to spend the next 20 minutes taking it apart. Good morning, it's Saturday, July 4th. I'm James Carter, and this is the weekend edition, The Week Graded. Know what to watch today, because today the market's dark and so, frankly, are we. This is where Elinor Whitfield and Marcus Brooks and I zoom out, grade the calls we made, and tell you what actually mattered. 4 threads this week. The AI chip valuation scare that started in Korea and ended with Nvidia flirting with 200. A jobs report that broke the labor market narrative even as the Dow hit a record. An earnings story that already told you what it's going to reward. And a genuinely strange split inside crypto. Before any of that, though, accountability. Elinor, Marcus, Thursday you both made a call on air. Let's see how it aged.
Go ahead, James. I'll take it.
Thursday you said, and I'm quoting you back, the single thing I'm watching is whether the S&P holds its first half gains as tech unwinds. If the index holds, it's rotation. If it can't, the character of the move changes. So, did it hold?
It held. S&P up 1.8% for the week, Dow up about 2, Nasdaq actually up 2.1, despite everything you're about to hear about chips. By my own test, that's rotation, not rupture. I'll take the win.
That's win number 1 on the season for Elinor Whitfield. 1-0, streak of 1.
Congratulations, truly. Mine's going to sound worse in about 4 minutes.
That's the setup, yes. You said the same day, rotation, and a healthy one. The market is finally paying up for AI revenue that's real and selling AI revenue that's a promise. That's not a top. That's a market growing up. Marcus, own it.
I stand by the framework. I do not stand by healthy. By Thursday night, the same day I said that Samsung and SK Hynix were each down 12%, Micron was down 13%, Nvidia was testing $200. Our own notes literally called it a valuation reckoning and the story that defined the week. That's not selective. That's a real re-rating, and I undersold how violent it got in real time.
I'll let him have this one without gloating. Mostly.
Mostly. So the ledger, Elinor Whitfield, call of the week, the index held exactly as she framed it. Marcus Brooks owns the miss, right on the mechanism, wrong on the word healthy. 1-0, Elinor. 0-1, Marcus, streak of -1. Let's go find out what actually happened in the thing you both were arguing about. Elinor, walk us through the chip story from the top, because it started well before Thursday.
It started Tuesday morning, actually, before most people had coffee. A semiconductor sell-off that began quietly Monday metastasized overnight into something global. Korea's Kospi closed down roughly 10%, Samsung and SK Hynix each fell more than 12%, and it tripped circuit breakers. Nasdaq 100 futures were down 2.6% before the U.S. even opened.
And the timing was brutal because Micron was reporting Wednesday.
Right, and here's the part I still find remarkable. Micron then delivered, by a lot of measures, the best quarter any memory company has ever printed. $41 billion in revenue, up 346% year over year, gross margin at 84.6%, and they guided next quarter even higher, to $50 billion.
A record quarter, in the middle of a sector meltdown.
In the middle of a sector meltdown, the stock still fell with everything else. That divergence, a company beating every number it has and getting sold anyway, is what a valuation-driven unwind looks like. Fundamentals stopped being the thing moving the stock.
I'd push on the fundamentals stopped mattering framing a little, though, because the actual news Thursday wasn't AI demand disappeared. It was a report that SK Hynix is slowing HBM4 expansion to redirect capacity toward commodity DRAM. And I went and looked at why. DDR5 margins are reportedly pushing 90% right now because of a supply crunch in ordinary memory, the stuff in your phone and your laptop, not data centers.
Wait, so SK Hynix isn't stepping back from AI because demand is weak. They're chasing an even fatter margin somewhere else.
That's my read, yes. That's a supply allocation decision by one very profitable company, not a referendum on whether hyperscalers still want HBM. Hynix's own 2026 HBM supply was already sold out before this. You don't slow walk a product you can't sell enough of because you're worried about demand for it.
I hear that, and it's a fair distinction. But I don't think the market made that distinction in the moment, and I'm not sure it's wrong not to. When one supplier's capacity decision can knock 12% off Samsung and trip a circuit breaker on an entire national index, that tells you how much of the AI infrastructure trade was priced for perfection, with no room for a single data point to go sideways.
Sure, but overreacting to a data point and that data point being bearish are two different things. Nvidia getting dragged to $200 because a competitor is optimizing its own product mix is, respectfully, an overreaction looking for a headline.
Except Nvidia's down 18% for the year on top of everything else layered in, a hawkish Fed chair, a market-wide valuation multiple, the cyclically adjusted price to earnings, sitting near 40, which is .com territory. I keep coming back to this number. The AI industry has put in over $1 trillion cumulatively and is generating, by most estimates, under $50 billion in revenue. That gap doesn't close because one supplier reallocated a factory line.
It doesn't have to close all at once. It has to be trending the right direction, and Micron's own guidance, $50 billion in one quarter, HBM4 revenue already past $1 billion, is evidence the demand side of that trade is still very much alive. I think you're conflating a memory market supply story with an AI demand story because they happen to break the same week.
So let's be honest with the listener. You two are not converging on this one.
We are not.
We are genuinely not, and I don't think we should pretend to.
Then here's the tiebreak, because I think there is one. Hyperscaler earnings Microsoft, Alphabet, Meta, Amazon land in late July. If their CAPEX guidance for the second half holds or rises, Marcus is right. This was a supply chain story that got mistaken for a demand story. If two or more of them trim CAPEX, or even just hedge their language on AI infrastructure spend, Eleanor's right. And the memory route was an early tremor, not noise.
I can live with that test.
Same, circle late July.
We will. Quick gut check before we move on, because the fear gauges are usually the tell. Did anything about this look like a panic, or did it look contained?
Contained is the honest word, and I want to give Marcus that much. The VIX didn't spike into the 20s, which is what you'd expect in a genuine risk-off event. It stayed relatively calm. Concentrated pain in one theme, not a market-wide flight.
Which is exactly why Reckoning is doing a lot of work in that headline. A contained, sector-specific correction inside a market that closed the week at record highs is not the same thing as the AI trade breaking.
Contained so far. Ask me again after the hyperscaler prints.
Moving to thread 2, and the print that actually kicked off the whole week's chain reaction. The jobs report.
57,000 jobs added in June against 115,000 expected. That's not a miss, that's a collapse relative to consensus.
Break down what actually happened underneath the headline, because I want the listener to understand why this one number moved everything from bonds to Rivian.
Two things stack on top of each other. First, the revisions April and May got cut by a combined 74,000 jobs. So this wasn't a one-month blip. The trend itself was already weaker than the market thought. Second, unemployment actually fell to 4.2%, and that sounds like good news until you see why labor force participation dropped to 61.5%, the lowest since March of 2021.
Translate that for someone who just hears unemployment went down. That's good.
People didn't find jobs and leave the unemployment count that way. They left the labor force entirely, so they're not counted as unemployed at all. The rate improved for the worst possible reason. That's not strength, that's withdrawal.
And the market's reaction told you which read it believed. Rate hike odds for the July 29th Fed meeting collapsed down to roughly 22% from a much higher number before the print. Traders priced this as the Fed's hands are tied, full stop.
And yet record Dow same day.
Same day, which is the paradox worth sitting with. The Dow surged nearly 600 points to a fresh record because rate-sensitive value stocks, financials, industrials rallied hard on the idea that hikes are off the table. But the Nasdaq fell the same session. One index's record is built on a completely different trade than the other index's weakness.
Give me a level, not just a vibe, though. What would tell you this rotation is real versus just a one-day pop?
Whether the S&P can hold above 7,500 with actual breadth behind it, meaning more than just financials and industrials carrying it, once full volume comes back Monday. A holiday week's trading doesn't prove conviction either way.
And I want to flag something Marcus found, because it's a genuinely different read on the data itself, not just the reaction to it.
Right? There's real pushback out there, including reporting that some analysts flatly don't trust these payroll numbers, calling the methodology itself misleading given how large recent revisions have run. I'm not saying I buy that fully, but it's worth the listener knowing the number itself is contested, not just its meaning.
I'd be careful leaning on that as a reason to dismiss a weak print, though. Convenient skepticism, deciding the data is wrong exactly when you don't like what it says, is its own trap.
Noted, I'm flagging it, not hiding behind it.
And Fed Chair Warsh's response to all this.
Called the jobs picture steady, which is doing a lot of diplomatic work for a report with a 50% miss and 74,000 in downward revisions. He's declined to commit to any rate path, deliberately, I think. He doesn't want to be pinned down before he has to be.
Which, fine, but it also means Wednesday's FOMC minutes, that's July 8th, are going to get read line by line for any daylight between what Warsh is saying publicly and what the rest of the committee actually believes.
Play devil's advocate with me for a second, Eleanor, because Warsh also used an appearance this week to say inflation is still too high. That's hawkish language sitting right on top of the weakest jobs print in a year. How does he hold both at once?
Honestly, he's boxed in, and I don't think that's spin, I think it's real. Wage growth is still running around 3.5% year over year, which is above where the Fed wants it. So you've got a labor market that argues for cutting and a wage number that argues against it. Neither hiking nor cutting is comfortable right now, and he knows it.
Which is itself a risk premium. Uncertainty at the top of the Fed gets priced straight into the most rate-sensitive assets, the same high-multiple names that just took the chip sector hit. I don't think that's a coincidence that both stories broke the same week.
So the jobs thread and the chip thread aren't actually two separate stories.
They're the same story wearing two different hats. Put a pin in the 8th. Let's take 30 seconds off the tape, because it's a holiday weekend and I refuse to spend the entire show being serious. Please go ahead.
I have watched 3 different colleagues this week try to explain the difference between rotation and rupture using a coffee analogy, and every single one of them made it worse.
Mine was good.
Yours involved oat milk curdling. It was not good.
The metaphor tracked.
It did not track. Anyway, happy 4th, everyone. Drink your coffee before it curdles or corrects, whichever comes first. Back to the tape. Thread 3, earnings. And this one's a clean callback to Thursday's whole theme, which was the market wants profit, not headlines.
Tesla is the case study. 480,000 vehicles delivered, up 25% year over year, comfortably ahead of the roughly 400,000 Wall Street expected. And the stock fell about 7.5%, its worst day in nearly a year.
Because the market's done grading Tesla on volume. They hit that number with aggressive price cuts, and everyone knows it. The only question left is what it did to margin, and you don't get that answer until the real earnings print on July 22nd.
And on the same day, a very different reaction to a smaller beat.
Rivian, 12,194 deliveries, above their own guide and above consensus, plus a raised full-year outlook, 65 to 70,000 deliveries now, up from 62 to 67. Stock jumped as much as 15% intraday, closed up over 9.
Rivian's had 2 years as the EV sector's prove it story, and Thursday it did. The interesting reframe is that the bull case was never really about demand. It was whether they could physically build enough cars. A beat Andres on both deliveries and guidance says the production bottleneck is finally loosening, right as their second model, the Artwo, ramps.
I'd hold my applause slightly. Rivian's still burning real cash every quarter, and at something like 3.5 times sales versus under 1 for the traditional automakers, a good deal of this turnaround is already priced in. The July 30th earnings print is where we find out if the cash discipline holds up to the scaling.
So Tesla, punished for a good number with a bad implication. Rivian, rewarded for a good number with a good implication. Same week, same sector, opposite verdicts.
That's the through line of the entire week, honestly, jobs, chips, all of it. The market stopped paying for headlines a while ago. It wants the number behind the number.
2 quick ones before we leave earnings and moves, because they're both structural, not just single-session noise. Alphabet officially joined the Dow this week, replacing Verizon.
Which is really just the index catching up to reality. AI, cloud, and digital advertising have been running the economy's growth engine for years, and legacy telecom hasn't been that for a while. It's symbolic, but symbols matter for what gets bought passively.
And the other one, Rocket Lab buying Iridium for $8 billion all in. Iridium jumped 25% on the news. Rocket Lab itself rallied almost 16%.
What's actually being bought there?
A vertically integrated space company. Rocket Lab gets Iridium's satellite network, its licensed spectrum, its 500-plus partner ecosystem, and suddenly they are a credible competitor to Starlink on sovereign communications and connectivity, not just a launch provider. It's the same consolidation playbook cloud and semis went through a decade ago, just showing up in space now.
Worth watching, but a mid-2027 close date means it's a story for next year as much as this one.
Noted, and back to the thread that's actually moving today's tape. Last thread, and it's the one that surprised me most this week, crypto, because the outflows and the price genuinely disagreed with each other.
This is a strange one. Bitcoin had a brutal June, down about 18% on the month, touched a 21-month low near 58,000. And spot ETF investors ran for the exits, over $4 billion in redemptions in June alone, a record.
But price didn't follow the outflows down, and that's the part worth sitting with.
Right while institutional money was leaving through the ETF wrappers, on-chain wallets holding 1,000-plus Bitcoin were buying at the fastest pace since 2013, something like 270,000 coins in a month. Exchange reserves hit a 9-year low. That's a real split between who's selling and who's buying.
And then this week's jobs miss changed the picture again.
It did. The soft print fed the same Feds on hold trade that lifted the Dow, and crypto rallied on it. Bitcoin pushed back above 62,000. And here's an update since our own notes went out. The 10-day ETF outflow streak actually broke Thursday. A couple $100 million came back in, the biggest single day in 2 months.
Which I'll take as a genuinely encouraging sign, but I want to be precise about what kind of rally this is. It's a rates rally, not a crypto conviction rally, Bitcoin trading like a leveraged bet on Fed policy, not like the scarce asset story people sold you 2 years ago. That correlation is worth remembering the next time someone tells you it's a portfolio diversifier.
I won't fight that. I will say the regulatory backdrop is a real overhang either way. The Clarity Act, the crypto framework bill, was supposed to get a Senate floor vote around now, and it stalled, odds of passage this year sliding as some ethics dispute holds up the calendar. That uncertainty tax doesn't go away just because price bounced.
So the scoreboard on crypto outflows breaking, whales still buying, price recovering, and the regulatory clock still stuck. Genuinely mixed.
Genuinely mixed is right. I don't love calling a bottom off one good Thursday.
All right, let's bring it home. Give me one call each, specific and checkable for Monday's reopen.
Mine's on the chip thread. If the Van Eck Semiconductor ETF can't reclaim its pre-sell-off level by Wednesday's FOMC minutes, I think the contained correction story starts to look shakier. And that's the first sign this spreads beyond memory into the broader AI-adjacent complex.
Mine's the flip side of hers appropriately. I'm watching Micron specifically. If it holds above $1,100 into next week without breaking down further, that tells you the sector sell-off was sentiment, not fundamentals, exactly like I argued today.
Eleanor watching the broad chip basket, Marcus watching the single name that reported the best quarter of anyone's career. We'll hold you both to it. That's the week, an AI valuation scare that Eleanor and Marcus still don't agree on. A jobs report that broke the labor market story while the Dow hit a record anyway. A market that's done paying for headlines without profit behind them. And a crypto market where the sellers and the buyers were, quite literally, different people. If the show helps, follow Nova Ventures Daily wherever you get your podcasts, and find our written notes at novaventures.us. That's your Nova Ventures Weekend Brief. Have a great 4th, and we'll see you Monday.